One of the most common pieces of investment advice in the world loses about 2 times out of 3. You come into a chunk of money, an inheritance, a bonus, a house you sold, and everyone tells you the same thing. Don't put it in all at once. Spread it out over the next year. It's safer. I tested that on every single starting month since 1871. Here's the test. $1, 2 ways. Version 1 puts the whole dollar in on day 1. Version 2 splits it into 12 equal monthly purchases. Run that on every starting month in Robert Shiller's dataset. 1871 to today. 1,855 of them. Everything inflation adjusted, dividends reinvested, and idle cash holds its real value while it waits, which is the generous assumption for spreading it out. 3 things came out of this. How often each one actually wins. Why holding for longer does not change the answer at all. And the 2 months in 155 years where spreading it out made a disaster worse. Full assumptions at the end. Code and data linked below. Here's every one of those start months. Each bar is one starting point. Left of the line, the lump sum ended ahead. Right of it, spreading purchases won. Investing it all at once won 67.2% of the time. But look at the shape, because the shape matters more than the headline. On the left, a dense pile of small losses. The typical shortfall from spreading it out is 3.6%. Not catastrophic, just a steady, boring drag. On the right, a thin tail stretching a long way out. Those are the crash windows. 1931, 1932. When the drip won, it won enormously. It just almost never happened. That's the trade in one picture. You give up a little, most of the time, in exchange for a rare, large payoff. And the longer you drag it out, the worse it gets. Spread over 3 months, the lump sum wins 62% of the time. 6 months, 65. 12 months, 67. 2 years, 72%. There's no window where waiting starts to pay. Every month you delay is a month you're holding cash instead of an asset that goes up more often than it goes down. Now here's the part almost nobody mentions. The obvious response to all of that is, fine, but I'm a long-term investor. Give it 20 years and it evens out. It doesn't, and not because of some subtle statistical effect, because of arithmetic. After your last purchase, both versions of you own shares of the same index. Nothing else is different. Whoever ended up with more shares stays ahead by exactly the same percentage, forever. The whole contest is decided during those 12 months. That's the theory. Here's the check. Every start month, held for 1 year, 5 years, and 10 years. If holding longer helped the drip even slightly, the gap between the two would shrink as the horizon grew. It moved by 2 times 10 to the minus 16. That is not a small effect. That is floating point rounding. It's 0. So, time in the market isn't advice about patience here. It's a description of the mechanism. The decision closes the day your last purchase clears, and nothing after that reopens it. Which raises the obvious question. If it loses 2/3 of the time and holding longer doesn't help, why does anybody do it? Because it does buy something real. It buys a better disaster. Look at the worst 5% of outcomes. At a 1-year horizon, the lump sum leaves you with 74 cents on the dollar in real terms. The drip leaves you with 76. That's about 3% better, exactly when it hurts most. That protection is not imaginary. That is the product being sold, and it works. At 2 years, it's still there. By year 3, it has almost completely closed. Hold that thought. So now we can ask the only question that actually matters. What does it cost, and how long does it last? The cost is easy. You pay it every time. Depending on the horizon, spreading purchases over 12 months costs between 0.5% and just under 5% of your median outcome. Every horizon on the chart. There is no holding period where the drip stops charging you. So that's the price. Now what does it buy? The protection is a different story. At 1 year, the drip's bad case is better by 2.3 cents on the dollar. That's the payout, and it's real. At 2 years, 1.9. Still there. At 3 years, it's 0.02 of a cent gone. So the thing you are paying for at every single horizon stops arriving after about 2 of them. And past that, I'm going to do something you don't usually see in a finance video. I'm going to tell you we can't measure it. These windows overlap. 1950 and 1951 are almost the same period. So 155 years of history does not give you 155 independent tests. At a 20-year holding period, it gives you 7. 7. You cannot compute a meaningful fifth percentile from 7 observations. The bars out on the right are noise, and if I told you what they meant, I'd be making it up. So the honest version is this. You pay the premium at every horizon. You can only demonstrate collecting on it for about 2 years. Here's the part one didn't expect. These are the 8 worst months in 155 years to have invested a lump sum, measured 10 years later in real terms. In 2 of them, spreading purchases out made it worse. And look at which 2. March and April of 1998. The 2 highest starting valuations in the table, Cape of 36 and 37. The exact moments when every voice in the room is telling you the market is overheated and you should ease in slowly. So let me show you what actually happened. Orange is the dollar invested all at once in April 1998. Teal is the same dollar spread over the next 12 months. Watch the shaded band at the start. That's the year the drip is still buying, and the market is climbing right through it. So every monthly purchase costs more than the one before. By the time the drip is fully invested, it owns fewer shares, and the gap you can see opening there never closes again. Then the dot-com crash. It hits both of them. Then the recovery. Then 2008 hits both of them again. 10 years after that final purchase, the lump sum dollar is worth 62 cents in real terms. The drips is worth 61. And that's the mechanism. Dollar cost averaging doesn't protect you from crashes. It protects you from crashes that happen while you are still buying. A crash in month 13 hurts you more, not less. Which brings us to the objection you're forming right now. Fine, but the market is expensive today. Surely that changes the answer. We took every start month that has a CAPE reading, about 1,700 of them, sorted them into 10 buckets from cheapest to most expensive, and asked how often the drip won in each. There's no trend. The most expensive 10th of history, CAPE 28 and up, the drip won 33% of the time. That's lower than several of the cheaper buckets. The best bucket for the drip is in the middle of the range, which is not a story about valuation. It's what randomness looks like. Starting valuation does not tell you which of these 2 to pick. If someone tells you it does, ask them for the deciles. So, all of it in one place. Investing it all at once beats spreading it out 67% of the time, across 1,855 starting months. Holding longer doesn't rescue the drip, because the outcome is locked in the day your last purchase clears. And the better worst case that the drip buys can only be demonstrated for about 2 years. So what is it actually? Not risk insurance. Short horizon regret insurance. And here's the honest ending. All of this assumes you actually invest. If splitting it into 12 pieces is the difference between you putting the money in and you leaving it in a savings account for 3 years because you're afraid, then 3.6% is a very cheap price, and you should pay it happily. The worst outcome on this entire chart isn't the drip. It's not being in the market. These are the assumptions. Change any one of them and the number changes, which is the point. The code and the PIN dataset are linked below. If you think one of these assumptions is wrong, go change it and tell me what you get. I'm not a financial advisor, and none of this is advice about your money. It's a simulation of what happened, with every input on screen. Next time, 1% in fees doesn't sound like much. Here's 30 years of it.